Hi everybody, this is Lara with your end of the week video for US oil for the trading week ending Friday 2nd of August. I was expecting downward movement. We've got an outside week and it has ended up strongly down for Thursday's session, but it moved up a little higher first within allowable limits. I still have the same midterm target, 35.25 for a third wave down. I'm expecting an increase in momentum. We could end with a capitulation spike. The final target remains the same. It's very low, I know, at 10.72, but if we see a new low by any amount at any time frame below 50.61, then I will have quite a lot of confidence in that target. I do have a bullish alternate wave count. It is an alternate because it does not have as much support currently with the data in hand from classic technical analysis. But if we see a new high above 66.59, that will be my only remaining wave count because the bearish wave count at that point would be invalidated. And then I would have a target for a third wave up at 89.80. And so if your own analysis of the market, using whichever tools you prefer to use, is very bullish, then you may choose to follow my bullish Elliott Wave count. But my classic analysis favours this bearish Elliott Wave count. The bearish wave count sees oil in a big three-step back pattern, which is unfolding as a double zigzag for a second wave. Those are relatively common corrective structures in second wave positions. The first zigzag subdivides 5, 3, 5 and is labelled cycle wave W. The double is joined by a 3 in the opposite direction, labelled cycle wave X. The second zigzag in the double needs to subdivide 5, 3, 5 and is labelled cycle wave Y, and the purpose of the second zigzag in a double is to move price reasonably beyond the first zigzag so that the whole structure has a clear slope, and so cycle wave Y would be expected to move reasonably below the end of cycle W. The target would see that achieved. The target is applied using Fibonacci ratio of equality, 1.618 between primary waves A and C. That's how I'm calculating that target. Let's take a look now at the weekly chart level where the high for cycle X is this point here. Here's the entire structure of cycle X. The difference between these wave counts is how I see this upward movement. From this low to this high, it's my judgment that it looks best and subdivides best as a three-wave structure, but it can also be seen as a five-wave structure. And that right there is the biggest difficulty of Elliott Wave, and one reason why using some classic technical analysis techniques or principles to guide your Elliott Wave counts is a really good idea. It is not always possible to tell with any certainty if a movement has subdivided as a three-wave zigzag or a five-wave impulse. They can look very similar indeed. This wave count sees this movement as a three-wave zigzag, the end of cycle X, the beginning of cycle Y, which needs to subdivide 5, 3, 5 as a zigzag. This channel is a base channel, is a channel drawn using Elliott's technique around a zigzag, or a correction from the start of A to the end of B with a parallel copy on the end of A. Along the way down, there will be bounces and consolidations. When price trends, it does not move in a straight line. Look out for strong resistance, for any deeper bounces to find good resistance now at the upper edge of this trend channel. If intermediate wave 2 continues higher, technically it may not move beyond the start of 1 above the invalidation point, but I would expect, if it did move higher, to find really strong resistance at that trend line and to react downward from there. Along the way down, a new low by any amount at any time frame below the confidence point would invalidate the bullish Elliott Wave count, which would provide confidence in this bearish Elliott Wave count. Let's take a look at the daily chart now, where the high labelled primary wave B here is this point here. To start, primary wave C, I have an impulse for intermediate wave 1, a zigzag for intermediate 2, and now intermediate wave 3 downward has a target to reach 1.618, the length of intermediate wave 1. Those of you who pay close attention to detail may notice that here at the end of intermediate wave 1, this wave count relies on a very small truncation. A truncation is when a fifth wave or a C wave, it only refers that term, which is exclusive, I think, to Elliott wave, refers only to fifth or C waves, when they fail to move beyond the end of the third or A wave of the same degree immediately prior. Here, minor wave 5 has failed by 0.11 to move below the end of minor wave 3. I'm going to allow it because it is within the context of a previous third wave that did move quite strongly, and so that's acceptable. Seeing intermediate wave 1 end here sees intermediate wave 2 as a 3-wave structure, and now intermediate wave 3 may have begun here. Intermediate 3 may only subdivide as a simple 5-wave impulse, the simplest of all Elliott wave structures. And so at minor degree it should have 1, 2, 3, 4, 5 to meet all Elliott wave rules. 3 has to move beyond the end of 1, that rule is now met, but it has to move far enough below the end of 1 and remain below there to allow room for minor 4 to unfold and remain below first wave price territory. At this early stage, within minor wave 3, no second wave correction within it may move beyond the start of its first wave above the invalidation point. At the monthly chart level, this is my alternate wave count. It is very bullish. It considers the possibility that the bear market for oil is over at this major low back in January 2016, and that there a new bull market has begun. And this does subdivide well, 5, 3, 5 as a zigzag. This wave count simply moves it all up 1 degree, and there's a hint or a tip for those of you who are learning Elliott wave. The easiest alternate to consider is always change the degree of labelling. That should be your first go-to alternate idea to develop an alternate wave count for pretty much any wave count you have. And so if the degree of labelling is moved up, it's possible the correction could be over, which means that a third wave up could be underway with a first wave at cycle degree over here, a second wave could be complete here, and a third wave of a third wave could be in its very early stages. Third waves should be unmistakable. They should have support from volume. They should have increasing ATR. They should have strength. With the data in hand at this stage, at this time, the beginning of a third wave of a third wave, at this stage, it does not exhibit the strength I would expect to see for a movement of this magnitude. And that's one reason why this is an alternate wave count at this time. The target for cycle 3 within super cycle 3 is for it to reach a common Fibonacci ratio to cycle 1. Within cycle 3, no second wave correction may move beyond the start of its first wave below the invalidation point. Not even a fraction of a cent on a tick chart is allowed. That rule is absolute, and so a new low by any amount at any time frame below this price point would add a lot of confidence to the bearish wave count. Let's take a look at the weekly chart level, where the end of super cycle 2 here is this low here, and now you can see how this upward movement could be counted as a 5-wave structure. 1, 2, 3, 4, 5. This will fit, and this illustrates quite nicely, if you look at it next to the other weekly chart I've published, illustrates quite nicely why it's so difficult sometimes to tell the difference between a 3 or a 5, and when that's the case, you have to consider both possibilities and fit it into the larger context. Often both ways will make sense and you'll have alternate wave counts, but not always. This wave count expects cycle 1 was over here. Cycle 2 does look like a zigzag at the weekly chart level. Labelling this as a zigzag has a better look. Cycle 3 may have begun here with an impulse for primary 1, a zigzag now complete for primary 2. This trend channel is important next week. This is a base channel drawn around the start of cycle 3, from the start of primary 1 to the end of primary 2 on this weekly candlestick right here, and then a parallel copy is placed on the end of primary 1. Lower degree second wave corrections should, not always, but almost always, they should find support for a bull market at the lower edge of a base channel drawn around a first and second wave 1 or more degrees higher. That's a rather long-winded way of saying this line should provide support if this is the correct wave count. And so early next week, if this trend line is breached at the daily chart level, that would add a little bit of confidence for the short term to the bearish wave count. If price bounces up strongly from here, if your outlook is bullish, it should bounce up strongly from here for this wave count to continue to have the right look. Let's take a look now at the daily chart level where the high of primary 1 is this point here. Here's the end of primary 2. This wave count avoids that little truncation that my main wave count has, so that's a slight point in its favour. And now, if we avoid that truncation from this low to this high, this upward movement looks really good as a 5-wave structure. And here is the end of intermediate 2, ending absolutely perfectly at the lower edge of that channel. Just note that I do for oil, I do my weekly and monthly charts on semi-log scales, but I draw my daily charts on an arithmetic scale, and it makes a very slight difference to how the trend lines sit. And here on an arithmetic scale, it is absolutely perfectly touched, and price for Friday has bounced up off there. If next week we see some downward movement below this trend line, it won't invalidate this wave count, it'll just slightly reduce its probability. Intermediate 2 may not move beyond the start of 1. A new low by any amount at any time frame invalidates my labelling of this at the daily chart level. For the bullish wave count, if that happens, I then have to consider the possibility that primary 2 could be moving lower as a double zigzag. The target for primary 3 is for it to reach a common Fibonacci ratio to primary 1. At the monthly chart level, we have the month of July here has moved price with a higher high and a higher low. It's moved price higher, but it's completed a doji, almost a doji. The real body is very small, not quite a line though. It's completed a red candlestick. The balance of volume is upward. Volume didn't have as much support for that month, or volume was not supporting upward movement that month. The strongest volume in recent months is for a downward month. This is a strong bearish engulfing candlestick pattern after a rise of a few months and a bearish long upper wick. This strong bearish candlestick pattern had a strong push from volume pushing price lower. That's quite bearish, and that supports the main Elliott wave count. This candlestick pattern also for this little rise could be considered possibly an advanced block pattern, which is also a bearish candlestick reversal pattern. However, it's coming in the context of just a small rise, but still the decline in ATR as price moved higher, each monthly candlestick is smaller. That is bearish, at least for the short term there. The only thing on this chart I will note, which is bullish and could support a bullish Elliott wave count, is the bullish divergence with price and on-balance volume. On-balance volume is making new highs where price is failing to do so. Upward movement, there is more push from on-balance volume here, and I read on-balance volume here as a leading indicator in the same way that Lowry's read the AD line as a leading indicator. And so I am interpreting that as bullish divergence that could be considered to support the alternate Elliott wave count. However, I have learned over the years that on-balance volume tends to be more reliable in the way it works with trend lines than it does with divergence. But in this instance, the divergence is quite strong. It's on the monthly chart and it's over a reasonable amount of time, and so it does have weight and does offer support to that bullish Elliott wave count. But for the short and mid-term, there is quite a lot of support for a bearish outlook, at least for the short to mid-term. At the weekly chart level, This week completes a spinning top candlestick, an outside week. The balance of volume this week was down, and on balance volume is giving us some signal here, and it's bearish. Downward movement within the week has volume actively pushing price lower. That's also bearish. What was support may now become resistance about 55, next support below about 52. A couple of weeks ago, after the small rise, there was a strong bearish engulfing candlestick pattern here, and it had support from volume actively pushing price lower. The short-term volume profile at the weekly chart level is bearish. ADX is still low. It's really close to 15. If it reaches 15 and the black ADX line starts to rise, coming up from a low level below both directional lines, that is the strongest signal ADX can give. If that happens in another week or so, then a new downward trend, because the negative DX line is above the positive, a new trend to the downside would be indicated in its relatively early stages. ATR gives quite a bit of support to a bearish outlook. As price is falling, ATR is rising. As price is rising, ATR is falling. Bulls are not able to push price ahead by a greater amount. The distance they are able to push price higher is smaller and smaller, evidenced by declining ATR. That's bearish. ATR tends to increase when price is moving in a trending direction, and it tends to decline when price is in a counter-trend direction. Again, price is falling, ATR is rising. A shorter term rise, ATR flattens off. Let's see if price starts to fall again, if ATR starts to increase again, that again would support a bearish outlook. But for now, with the data in hand, this look supports a bearish outlook for the short to mid-term. I've already noted the signal from on-balance volume. It's not a strong signal. This line has some slope. It's not too steep though. It's been tested 3 times prior, and this is the weekly chart, and it's not too long held, but it has a reasonable duration, and so this is a reasonable bearish signal, not a strong one. It is, however, a bearish signal, the break below support, and I do give on-balance volume a little bit more weight when it gives signals breaking above support and resistance line than I do with its divergence. That does, in my experience, tend to be a little bit more reliable. RSI is neutral. There is plenty of room for price to rise or fall, and stochastics still in neutral territory. What about the short-term picture at the daily chart level? This is a very bearish candlestick for Thursday's session, and volume was actively pushing price lower. Again, for a short-term outlook, this does support a bearish outlook. The moving average situation is overall bearish, but not fully so. They all have negative slopes. The short is below both the mid and the long, but the mid-term Fibonacci 55-day moving average, that's the purple one, and the green long-term 200-day moving average, that's the green one here. The mid is above the long. They've been doing a little bit of whipsawing. We had the long cross below the mid, but I'm using a 55-day average, not a 50-day average. And so let's see how those two behave in the coming days next week. ADX at the daily chart level is above 15. It's rising up from low levels, but coming up from below both directional lines. It tells us that at the daily chart level, the market may be in a downward trend in its relatively early stages. This is the strongest signal ADX can give. We've already been over ATR. It essentially tells the same story at the weekly and daily chart level. On balance volume last week broke above weak resistance. It's at a relatively high level compared to price. It's at the daily chart level also indicating some bullish divergence, but I'm not going to give that too much weight, and I already have noticed that or noted that at the monthly chart level. RSI is neutral, as is stochastics. There is plenty of room for price to rise or fall. And when markets trend, stochastics can reach extreme and can remain there for a long period of time. In a trending market, I will use RSI, preferred over stochastics, to indicate when the trend may be getting extreme, overbought or oversold. That's all from me this week with your oil analysis. I hope that all of our members are having a fabulous weekend.